Hello, everyone, and welcome to another Wall Street from Main Street podcast. Today, we have a returning guest, Jason Stevens from Sprott. Jason, welcome back.
Thanks, John. Good to be here.
All right. So first thing I want to ask you is recently you wrote an article about diamonds being a great investment. Would you be willing to tell our audience about what you've seen? Because this is definitely new to a lot of people who haven't read your article.
Yeah, so I guess the biggest thing to keep in mind is that diamonds are unlike any other commodity business. Not every unit, not every diamond or none of them are the same. And at the same time, there are specific supply-demand issues that with this market that you won't see in any other commodity markets. There's about 25 mines globally that produce 95% of the global supply of diamonds. And we see that global supply peaking at around 2018. That gradually declines going all the way out through 2030, while at the same time we see most of the developing world taking on the diamond engagement ring tradition. So as we start to see over the last few years, we've seen global diamond demand grow at something in between 5 and 11% annually. And we expect that in 2015, 2016, and 2017 for that to be the case as well. So as we see production coming off, we see global demand continuing to rise with an increasing top 1% of households continuing the majority of the buying in the finished diamond market.
Yeah, that actually sounds like an interesting way of playing the growing wealth in the developing world. And a lot of people, when they think of diamonds, they think of basically it's all produced in South Africa, or I forget which part of Africa, but 90% of them are thrown away, and it's artificially, there's a lot of them, an excess of them. Is that remotely true, or is that just...
I don't know that they're majority thrown away, but there are micro diamonds which just don't have much economic value. And then you were right that the majority, I would say, I don't want to say majority, a good amount of the diamonds come from the southern part of Africa, a good amount comes from Russia, and then the rest basically comes from Canada. So those three spots produce 95% of all the production. There are mines in Australia. There are mines in newest discovery on a commercial basis was the Bunder mine in India. So there are other areas looking for diamonds, and I would say 50% of the exploration budgets that have been pointed towards diamonds have all come out of Russia with very little success over the last 10 years. The last major discovery was made over 25 years ago. So the diamond business, because of politics, financings, all these other things, it takes about 14 years on average for a mine to go from discovery to production. So even if we did have discoveries coming online over the next 5 years, that's not going to change the global supply anytime soon.
All right, that's very interesting. It was when I first got that article, I was like, diamonds, wow, this is really an outside-the-box investment idea. So that sounds pretty neat. And not only that, if someone listening is getting married soon, they might want to hold on to that diamond ring. It might be worth a lot more in 4 to 5 years.
So, John, when you say it's kind of outside the thinking of a lot of resource investors, that's totally true. But the way I kind of frame it and what I've come to realize is that the top 1% of people are the ones that make up close to 30 to 40% of the demand globally. So if we continue to see QE infinity, not only in the U.S., but globally in China and all these other developing nations, we have misallocation of capital. We have higher incomes at the top 1%. Those are the people buying the diamonds. So demand will stay strong even if the global middle class doesn't grow.
Oh, definitely. I definitely see that. And QE has distorted, like you said, caused mass distortions of income inequality or great gaps of income inequality, and they're going to buy diamonds, especially Wall Street.
Right.
And everything. And my next topic is you also write about oil and gas, and it's had a recent big takedown lately in prices. And from a value investor standpoint, if you're underweighted or don't have a position yet and you just buy metals, this looks like a good time. And I was wondering what your thoughts on oil.
Well, so the biggest misconception I think right now is that the global glut of oil coming out of the U.S. is all technology driven, which it's not. It's another misallocation of capital. It's low interest rates being available for the North American oil and gas industry. So that ship has sailed, and over the next 6 to 8 months, I think that credit line that has been infinitely available to most of the exploration production here in the U.S. and Canada is going to dry up. So with that said, credit lines are going to be slashed. The companies that were under leveraged are going to be in the best position to benefit, and finding the companies that will survive and then thrive in what I believe will be in the next probably year. I would suspect that we're going to see real drastic production cuts and production effects by the third and fourth quarter of this year. I would suspect that we're going to see something like $55 to $65 oil exiting 2014 or 15.
Yeah, not only that, the rig counts are just dropping precipitously, and there's also one shale oil. You talk about the credit line. One shale oil company's already declared bankruptcy, and it's only been roughly 4 months into this sort of collapse, 4 to 6 months. I know the takedown began in June, but the real low prices, I think, started to come into the market at November. So I definitely see that coming. And not only that, just it doesn't seem. What do you think of the global demand? Do you think that's really so poor, or do you think it's just decreased? The increase is decreased.
So, prior to the oil price collapse, we were oversupplied by about 3%, which has predicated or has started a 55% decline in oil. By our estimations, to really clear the market, to create a good balance of production and demand, you could do that with $60 oil. So everybody talking that Saudi Arabia wants $45 oil or really low oil prices, it's not true. They want to cut out the marginal producers, which they can do at $65 oil. At $45 oil, they're just eating into their own profits. So in my mind, you see this paper or this futures market reaction to what traders believe the Saudis and OPEC are saying, but it's really not what they intended, and I think they got an overshot to the downside with where oil prices are now. And now there's uncertainty, so it might stay here for a while, but once we start to see OPEC meet in June and we start to see the rig count go next to nothing, and we start to see all these other supply issues or new drilling come offline, CapEx budgets being completely cut, all of that will have an effect, I think, by Q3 and Q4 of this year.
Yeah, and not only that, Saudi Arabia, I remember reading they're going to have their biggest budget deficit this year, so they'll probably need higher prices soon because 90% of their export revenue.
Yeah,
So,
there's a very good analysis, and I can't remember who did it, but basically trying to put into perspective what oil price they need to keep up with their social programs, and it's much higher than $80.
yeah, I read 94 for Saudi Arabia. It's not just Saudi Arabia though, too. Venezuela, they're already pounding the doors because they're going to go broke. Now, I don't think it's low oil prices that led to their collapse. It's Hugo Chavez and the socialism. I just think the low oil is the nail in the coffin. But Iran, Nigeria's having trouble. So a lot of these national governments and OPEC, it doesn't seem like they can last this for as long as they say. It seems like. And the most amazing thing about this oil collapse is you see a lot of energy companies selling off with it. One example is uranium. It just went down with it, even though it's an electricity part. And what are your thoughts on uranium going forward?
I think that it will be viewed as a substitute for oil, rightly or wrongly. I think that it's going to be viewed as a substitute. And until we start to see uranium companies making a profit, which we won't see at $35 a pound uranium, you're going to have to see something closer to $75 uranium before you have free cash flow coming out of even the biggest producers, the Camecos, the Arevas, those sort of companies. So unless oil prices, I think, make a dramatic comeback, you're not going to see a real comeback of uranium prices. But with that said, if you're looking for value in the uranium space, this is the time to do it. And that means new discoveries. That means high-grade assets. Some of the highest-grade assets in the Athabasca Basin, you want to talk about on sale. These things are on sale, but I can't see them. A real contrarian needs to be willing to wait, I think, until 2017 to really see the kind of upside a speculator wants to see.
Yeah, that is true. You see, as you said, viewed as a substitute for oil. You see a lot of alternative energy selling off. Even fracking sand sold off despite their financials increasing. Some of them, one company I looked at, I can't say it for all of it because it's just one company, but their actually financials have improved. And in terms of, you were talking about $65 to $75. Is that price also true for the in situ producers?
You're talking about the in situ producers from, you're talking about in situ recovery as opposed to conventional. Okay. So I would suspect that the highest grade underground is probably going to still take about $65, $70 oil, or $65 to $75 pound uranium. In terms of the in situ leach recovery, I don't know. I couldn't, because there's not enough large scale projects in that arena. There's UEC doing that stuff in Texas, but I can't foresee that being on a larger scale. So it might be specifically towards that project that you're looking at.
Yeah. Okay. Yeah. I just meant them. There's a couple of juniors in there, so that do that. But yeah, it's not.
I would actually suspect that it's pretty high. It's higher.
Yeah. Okay. And getting back to what Sprott's known for, the precious metals industry. You're pretty close to financing and people coming into the market. What are you seeing right now in terms of the miners and access to capital?
It's funny because the same phenomena that we're seeing right now happened in 2014. We saw a dramatic sell-off at the end of 2013 and a good move from, I think it was somewhere around 1,200 to 1,400 at the beginning of 2014, and then peaked in March and sold off throughout the rest of the year. Now we're starting to see a recovery in gold prices. And this was the time last year when you saw many of the junior miners raise financing. In fact, January and February, we did more financings in 2014 than we did all of 2013. So those same juniors are not coming to us this year, even with this price spike. Now, it's still early. It's only January, and we still have, a couple months before, maybe some of these guys have to put the pin and the have to succumb to, longer term warrants or the financing terms that we're looking for. But at the end of the day, we still see a lot of projects that need to be financed and no exploration being done right now. You can look at the whole universe of juniors in Canada. Very few of them are doing much exploration other than what their base minimum obligation is. So if you want to, I don't think it's going to be an exploration-based recovery in this sector. I think it's going to be M&A-led, and then when we see these spikes up on the gold price, that's when we'll start to see the financings. So maybe that'll be over the next 2 months. Maybe that will kind of be predicated based on the needs of the companies, which the needs of the companies are, getting pretty dire in some cases.
So the needs of the company, it's really getting that dire in the mining industry for some of them, or?
Well, you've seen a lot of companies that were trading plus $50 million market caps that are now doing reverse splits. So I'd say it's getting pretty bad. They're doing these reverse splits to stay on their exchanges. So I'd suspect it's getting pretty bad out there. Now, what that predicates for the M&A, we're starting to see M&A. We're starting to see companies being bought out for specific projects. Virginia was bought by Osisko Royalties to create kind of a major North American royalty company. That is going to be of interest. I think those two North American royalties will be of interest of both Franco-Nevada and Royal Gold. I don't know if that's immediately, but the management team for Osisko is now going to include the Osisko royalty or the Osisko management and Andre Gamon from Virginia, who will, I think, put together a good Quebec-based exploration program. Whether or not that results in more royalties or if it's going to be an exploration arm of the company, all these things will allow them, or this M&A will allow them to use cash for new investment, which is what the industry is lacking right now.
Yeah. In terms of industry lacking, do you see great opportunities for just royalty and streaming companies to make good deals, or very favorable ones right now?
Well, yes, but in my mind, the last 2 years, they've made some great deals. So the one thing with metal streaming and royalty deals is that a lot of times they don't pay off for 7 or 8 years, which, that's how they've built the business. There's a lot of optionality to these contracts. I just think that these companies, I think Royal Gold just reported something like 30 cents profit for the quarter, so 30 cents per share.
Oh. Yeah, I know they've done really well because Mount Mulligan just came online.
Right.
And that's becoming profitable, so I know Royal Gold's been doing pretty well. So right now it still seems... what are your thoughts about some of these companies? Like you got First Majestic, they are trading basically similar to its 2008, 2009 at $6. You have a lot of these mid-tiers trading like junior miner companies. Or what are your thoughts on those? Do you think instead of buying juniors, maybe some people are better off now buying mid-tiers just because they can possibly get the same type of capital gains as a junior?
Absolutely. I think the best thing about bull markets is that you can upgrade in quality. You can go from investing in juniors that, the whole sector's come down, but you can get similar upside with higher quality assets. And that's what I'm doing, is that if I can take less risk and have, comparable upside, why wouldn't you do that? And I think that that's the play for most people. You can still speculate on a smaller percent of your portfolio in the real exploration game, but there's no reason to take more risk without seeing. And the other thing is that when you start to see the gold prices move up, the exploration, the real bottom of the barrel, less than $40 million market cap exploration companies, they won't initially move. What will move are the developers, the mid-tiers. So you can make money on those, take some profits, and start to move down the quality scale as the mid-tiers start moving up. That makes sense for some people, but again, it all depends on the person and the strategy.
Oh, yeah, that definitely. I always look at this as a great opportunity just because you can get some of these companies that are trading at their 2008 levels or even below it because the market's so hated. But as they say, Rick Rule said it best, bear markets are authors of bull markets.
Yeah, and I think the biggest concern for most investors is when. And I try to beat home the fact that it doesn't matter. If you cover your downside, you buy the best of the best, and you start looking at fundamentally protected valuations. Quite frankly, much like you're seeing in the oil and gas industry, when you can see free cash flow being the main driver of future growth, there's only a handful of companies that can make free cash flow at $50 oil. But finding those companies that can sustainably keep that cash flow, pay their dividend, not pay their dividend, but still grow the business, there are a handful of those companies, even though on a global scale or on the North American scale, most of the industry is bankrupt. But you can find those specific ones that will, make the whole process of due diligence and research worth your time.
And I have one other question. You actually brought up oil and gas. To you right now, how important is a oil company? How important is their hedge book right now to you?
Oh, extremely important. Now, that's another wild card for the industry and a lot of these companies is that there's a series of companies that we're doing due diligence on right now that have anywhere from 40 to 60% of their production hedged north of $95 a barrel, in some cases up to $105 a barrel. So that will, like I said, most of the businesses of the North American E&P business is broke at $50 oil. So if you have something that brings your overall realized oil price up closer to $70 to $75 a barrel, that gives you a lifeline to figure out, do I need to divest of assets? Do I need to cut a dividend? Do I need to start focusing more of the capital budget on certain projects with a higher payback period or lower payback period, higher internal rate of return? So all of these things are, these are not the companies that are going bankrupt already in this cycle. These are not the shale oil companies. So the hedge book is totally necessary, and the companies that have debt, that have high debt but have this hedge book, have that much more of a lifeline than they did, without the hedge book. The debt is going to be a main component and a problem, but these bankers, just like in the housing crisis, these bankers don't want to end up with oil production. They want to work with these guys, but at the same time, the credit lines are going to be cut, and they're probably going to be cut meaningfully.
Yeah, I definitely can see that. So hopefully it won't lead to I was reading somewhere there was a 1987 savings and loan, and it started with a Texas bank. because of the energy crash. So, but you never know. When credit lines get cut, they get cut. So, I'm basically out of questions. So, thank you for the interview. And if people wanted to find out more about you, sign up for your newsletter, or possibly they need someone to manage their money, how can they find out more about you?
They can always email me directly, jstevens, Stevens, at sprottglobal.com. They can also go to the Sprott Global webpage and click on About Us, and they'll find my profile next to my colleagues. So, again, it's Jason Stevens, but they're also welcome to call me, 800-477-7853.
All right. Thank you for coming on, and I strongly suggest go to Jason Stevens and at least sign up for the newsletter. He always has good articles, and he's not going to fill up your email box. It's sent at a good amount of time. So thank you for coming on.
Thanks, John.